Welcome. In this video, the price for Zbcn coin has collapsed. What will happen? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
When we talk about a descending trend structure, what we actually mean is that the price has been moving downward for a certain period of time by continuously making lower highs and lower lows. This structure can be easily observed in technical analysis with the help of a trend line. Investors typically draw a line connecting the highs, and this line shows how strong the downward pressure on the price is. However, it's important to remember one thing: no trend lasts forever, and every trend has the potential to break. That's why the price moving above this descending trend line can be a very critical signal for investors. Because in such a case, the long-standing bearish psychology of the market is broken. Sellers lose dominance to buyers, and the price can suddenly surge upward as if breaking free from its chains. In technical analysis, this is often called a trend breakout, and in descending trends especially, breakouts can trigger very sharp upward moves. When the price moves above this trend line, it essentially shows that the market participant's mindset is starting to shift. For a long time, most investors expect the price to keep falling, which sustains selling pressure. But once the price breaks above the descending trend line, that perception suddenly reverses. Investors now start thinking the price is preparing for a new wave of growth. This causes a serious surge in demand. For followers of technical analysis, such trend breakouts are considered very strong buy signals, because once the price breaks above the trend line, it often accelerates quickly and makes a strong upward move. This kind of surge attracts not only retail investors, but also large institutional buyers. Once they see the breakout, they start increasing their positions as well, which accelerates the upward movement even further. When such a breakout occurs, a situation called a short squeeze often happens as well. In other words, investors who open short positions expecting the price to keep falling begin to lose money when the price breaks upward. To stop their losses, they are forced to quickly close their positions. Closing a position in this way actually means buying in the market. This adds even more fuel to the ongoing rally. Therefore, the breakout of a descending trend is supported not only by new buyers entering the market, but also by short sellers being forced to cover their positions, making an upward explosion almost inevitable. In addition, the breakout of the descending trend line is not only a psychological shift, but often aligns with many technical indicators turning positive. For example, the RSI indicator typically rises from oversold regions before such breakouts. The post-breakout upward move is often described as an explosion because the price can cover huge distances in a short amount of time. Investors, often unprepared for this kind of move, rush into panic buying once they see the price accelerating, which further strengthens the rally. Interestingly, these kinds of breakouts sometimes happen not only because of technical indicators, but also in parallel with fundamental developments. For example, positive news about a project, an improvement in overall market sentiment, or a macroeconomic factor can all help the price break the descending trend. In such cases, the combination of technical and fundamental factors can propel the price upward like a rocket. From a psychological standpoint, the breakout is also very significant, because investors stuck in a long bearish trend often fall into despair. Since every new high is lower than the previous one, they constantly think, how much lower can it go? But when the price suddenly breaks above the trend line, that despair turns into excitement. Investors regain lost confidence, and the market enters a hopeful and optimistic mood again. These psychological shifts make the technical breakout even stronger, because the overall sentiment of the market has changed. Another important factor to watch in trend breakouts is the retest move. Very often after breaking the trend line, the price pulls back for a while to test the broken line. This is a very important stage to measure the strength of the new uptrend. If the price manages to hold above the broken line, this is the strongest confirmation that the descending trend has truly ended and a new bullish cycle has begun. In this case, investor confidence grows even further and buying accelerates. In conclusion, the breakout of a descending trend line can be a signal of an upcoming explosion in price, because these kinds of breakouts represent a major shift not only from a technical standpoint, but also in terms of psychology, fundamentals, and volume. Once the price moves above this line, sellers lose all control, buyers dominate the market, and the upward move accelerates quickly. That's why one of the most critical points for investors to follow is whether or not descending trend lines are being broken. If such a breakout occurs, the market often reacts with an explosive move, and the price can reach very high levels in a very short time. This is why breaking above a descending trend line is not just a technical detail, but one of the most important factors determining the overall direction of the market. The rallies that follow often exceed expectations, and during such times, investors encounter what could be once-in-a-lifetime opportunities. For patient investors who carefully track trends, these opportunities can bring huge gains. After a long bearish trend, a breakout is like the beginning of spring after years of waiting, and it opens the doors to a new period filled with hope, confidence, and profit for everyone in the market. But we can't make decisions based on trends only, so let's also take a look at the other metrics. Stay tuned.
A squeeze in the Bollinger Bands is one of the most striking and closely followed formations in technical analysis. This is because it usually signals that the market is calming down, volatility is decreasing, but this calmness will not last long, and a strong price move is about to happen. During periods when the bands tighten, most investors try to guess the next direction of the price. However, the key point is that the squeeze acts like a period of silence. This silence is often like the calm before the storm. In other words, the price moves within a narrow range for a while, trading volume relatively decreases, and market participants go into wait-and-see mode. But after this squeeze phase, there usually comes a very sharp breakout. This breakout can mean either a strong upward surge or a steep drop. Therefore, seeing a squeeze in the Bollinger Bands actually signals that a big opportunity in the market is approaching. During the squeeze, the bands move closer together and the price on the chart looks almost compressed. In these periods of compression, many traders grow impatient and enter positions too early. Yet the logic of the Bollinger Bands tells us this: volatility is never constant, and a squeeze is always followed by an expansion. During that expansion, the direction of the price becomes clear very quickly and strongly. Especially if the squeeze has lasted for a long time, the breakout tends to be even more powerful. This is because the energy built up in the market during this time is very large, and eventually that energy is released in one direction. This release usually happens alongside an increase in volume. The price breaks out of the narrow band, the bands rapidly widen, and the foundation of a new trend is laid. At this point, what investors should focus on is which direction the breakout will take. Unfortunately, the Bollinger Band squeeze itself does not give definitive information about direction. However, when combined with other technical indicators and price action, it is possible to anticipate the direction. For example, if the price is moving near the upper band while the bands are squeezing, the likelihood of an upward breakout is higher. Conversely, if the price is compressed near the lower band, the odds of a sharp downward move increase. Still, the market can sometimes be deceptive, and so-called fake-outs can trap traders in the wrong direction. That is why during a squeeze, it is important to remain patient and wait for confirmation signals. The psychological impact of the squeeze is also significant. After watching the price move in small waves for an extended time, market participants become impatient. The thought, "a move is coming soon," becomes dominant. This expectation can accelerate the breakout even more. When algorithmic trades and large investors' orders kick in, retail traders' stop-loss orders also get triggered, making the breakout even sharper. This is why post-squeeze moves are often one-sided and powerful, with the price covering a lot of ground in a short time. The logic of the Bollinger Bands is actually based on statistical calculation. Upper and lower bands are drawn around the average price according to standard deviation. These bands represent the natural fluctuation limits of the price. Normally, the price moves within the bands most of the time, but during a squeeze, the standard deviation decreases sharply, causing the bands to contract. A decrease in standard deviation means low volatility, but in financial markets, volatility cannot stay low for long because markets are inherently dynamic. That's why expansion after a squeeze is inevitable. Looking at historical data, it can be seen that almost every squeeze in the Bollinger Bands is followed by strong moves. Trend beginnings, in particular, are often triggered by these squeezes. When the bands compress, the price chooses a direction and ignites a new trend. For this reason, many traders place Bollinger Band squeezes at the center of their trading strategies. However, one crucial point must be remembered. Predicting the direction of the move after the squeeze is difficult. This is why investors should never trade without a stop-loss. The smartest approach during a squeeze is to patiently wait to see which direction the price will break. If the price breaks the upper band with strong volume, this usually signals the start of an uptrend. Conversely, a decisive break below the lower band can trigger a downtrend. In highly volatile markets like cryptocurrencies, these moves can be extremely sharp. Sometimes the price can gain or lose dozens of percent within just a few days. This is why Bollinger Band squeezes also represent moments of great opportunity. One of the most common mistakes in these setups is entering trades before the price actually breaks out of the band, because during compression, the price can make several small moves up and down, which misleads traders. But after the band squeeze and the real breakout happens, the direction becomes much clearer. That is why it's so important to be patient and wait for confirmation signals. Another important point is this: not every sharp move after a squeeze is permanent. Sometimes the price makes only a short-term breakout and then returns to previous levels. This happens more often in low-volume markets, but in high-volume markets, especially when the squeeze has lasted for a long time, the breakout usually marks the start of a new trend. That is why long squeezes are much more significant for traders. To sum up, seeing a squeeze in the Bollinger Bands is a sign that a storm is approaching in the market. That storm could be upward or downward, but whichever direction it takes, a sharp breakout almost always follows a squeeze. During this breakout, the price moves very quickly, the bands start widening, and major opportunities arise for investors.
Drawing Fibonacci levels from bottom to top is one of the most commonly used methods in technical analysis to identify potential reversal points in price. In particular, the 0.618 and 0.786 levels are considered critical by investors. This is because these levels represent areas where prices can gather strength both psychologically and mathematically, marking zones where buyers may step back in. If an asset has moved strongly upward from the bottom and formed a clear top, the following correction often takes place toward Fibonacci levels. In this case, a retracement to the 0.618 or 0.786 levels is actually viewed as a normal and healthy correction. These points are important because they allow the trend to maintain strength and prepare the ground for a new upward wave. In a scenario where price moves from bottom to top, Fibonacci levels act almost like a roadmap. Levels such as 0.382 or 0.5 are often where short-term buyers step in, but in strong trends, retracements usually extend deeper to 0.618 or even 0.786. At these points, the probability of a reversal to the upside increases. These levels are where buyers tend to open positions more aggressively, while sellers begin to lose strength. The 0.618 level in particular is known as the golden ratio, and just as it represents perfect balance in nature, it plays the same role in the markets. As a reflection of human psychology and mass behavior, the buying pressure that emerges here plays a major role in driving the price higher. If the price retraces to the 0.618 level and finds strong support, this is generally interpreted as a sign that the trend remains healthy and the uptrend is likely to continue. Buyers become more aggressive at this point because they recognize that price has reached a potential reversal zone. The 0.786 level represents a deeper correction. This level is typically where patient, long-term investors step in, taking on risk and making strong purchases. As a result, reversals from 0.786 are often sharp and fast. At this point, panic selling has usually faded, while strong investors show increased buying appetite. That is why price reaching 0.618 or 0.786 in a bottom-to-top Fibonacci retracement is seen as a critical area where buyers are likely to cluster and the trend may revive. Investor psychology also plays an important role in such cases. For example, many investors who missed buying at the bottom wait for a correction after the price rises, and the most reliable zones for such corrections are typically the 0.618 or 0.786 levels. These areas become accumulation zones. Large players, institutional investors, and experienced traders monitor these levels closely because moves starting here are often the beginning of a new impulse wave. When combined with Elliott wave theory, reversals at 0.618 or 0.786 can often mark the end of the second wave or the completion of the fifth wave rally. The reversals from these levels are not only a matter of technical analysis, but also reflect market structure and the balance of supply and demand. The strength of sellers lasts only up to a point, but once buyers' critical levels are reached, the balance shifts. That is why reversals from 0.618 and 0.786 are often sudden and powerful. When sellers are exhausted, buyers' pending orders are triggered, pushing the price upward quickly. These reversals sometimes take the form of a sharp V-shaped recovery, and sometimes they build gradually, restoring the uptrend. Candlestick formations at these levels also matter for confirmation. For instance, at the 0.618 level, strong bullish candles, engulfing patterns, pin bars, or wicks provide additional signals of a reversal. At the 0.786 level, sharp wicks followed by high-volume bullish candles are often seen. This is because the area marks the end of panic selling and the return of market confidence. In the eyes of investors, these levels are also considered the last defense zones of the trend. Even if price retraces to 0.786, the main uptrend may still be intact. Long-term investors often view these levels as strategic buying zones. For short-term traders, they are critical for stop-loss placement and risk management. If the price continues to fall even after 0.786, it may signal that the trend is weakening or breaking down entirely. However, more often than not, the market finds support at these levels and begins a new upward move. Sometimes this move is strong enough to break the previous top, and sometimes it develops as a more controlled climb. In conclusion, when the price retraces to the 0.618 or 0.786 levels in a bottom-to-top Fibonacci setup, these levels are considered the most reliable reversal zones in technical analysis. Reactions from these points indicate that buyers are stepping in, sellers are losing strength, and the probability of the trend turning upward increases. In the market, these levels are seen as golden opportunities, and most investors follow them with great attention. In other words, this is where price often reverses, and from a technical perspective, moves that begin at these levels can bring strong gains to investors in the long run.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.